Hello, good morning, friends. Come to this wonderful chapter, bond valuation once again. We have done up to this. The topic right now going on is interest immunization. And we have done one problem where we have seen if the interest rate rises to 8%, remains 8%, falls to 6%, or rises to 10%, the amount received by the investor is remaining the same. Is it right? So write a small note for this question. This note is pending. Students, please write this note. In all the three cases, the total realization is almost the same. In all the three cases, the total realization is almost the same. The total realization is almost the same. This is possible only when the duration of the bond matches with investor's time horizon. This is one condition. If you fulfill this condition, you are immunized from changing interest rate risk. Duration of the bond should match with the investor's time horizon, that is, in this case duration is 5 years and the liability to be paid is also after 5 years. Third point, write the change in market interest rate does not affect the return. The change in market interest rate does not affect the return because in all the three cases he has got almost 10,000 rupees. And the last point, write on the bond investment remains immunized. The bond investment remains immunized against the interest rate risk. The bond investment remains immunized against the interest rate risk. Bond investment remains immunized against the interest rate risk. So this is the answer of this wonderful question. And with this example, I have proved that if you ensure that duration of your bond portfolio is equal to duration of liability, the changing interest rate will not affect the value of the bond. The realization will remain almost the same. Okay. So now we'll take one more good question. Question number 64. Again, one more question for understanding the concept. So please come to question number 64. Consider an investor with the following stream of liability. Now previous question we had only one liability after 5 years. This time the liabilities will be paid at different points of time. So we have three liabilities. Year 1, the liability amount is 200 lakh, year 4, 100 lakh, year 5, 400 lakh. So if you have more than one liability, you will have to calculate the duration of liability also first. So first we have to find out what is the duration of the liability, and then the opportunity cost of fund is 12%. That is my discount rate. He wants to invest in a portfolio of the bond such that his liability is immunized. He wants to invest in a portfolio of bonds. He wants to invest in more than one bonds so that his liability is immunized. That means he will be able to pay this liability at the end of year 1, 4 and 5. The following two bonds are selected. So in order to immunize the risk, they have decided to invest in two bonds. Bond X, which is a 1 year 0 coupon bond and the yield is 12%, and bond Y, which is a 7 year 0 coupon bond and the yield is 12%. So the first question is calculate the proportion of funds to be invested in these bonds. How much amount you will invest in bond X and bond Y in percentage term, as well as the amount to be invested in rupees term also, and the face value of the bond also. You have to calculate the percentage to be invested in two bonds, amount to be invested in two bonds, and what would be the face value of the bonds. And in order to convince you once again, we will also give the proof of immunization. In the exam, they don't ask you this proof, but as a good student, as a learner, we have to ensure that by following the strategy of matching the duration of liability with duration of asset, we will be able to pay these liabilities at respective point of time, even if the market rate of interest changes. Okay, so are you ready? Say yes, we are ready. So first we'll compute the duration of liability. Write step 1, duration of liabilities. Write down step 1, duration of liabilities. Same format. First column year, second column amount, third column discounting factor at 12%, fourth column present value, and fifth column year into present value. So please solve. Keep the question in front of you. Year 1, 4, 5. Amount 200, 100, 400. Take your calculator. Calculate the present value factor 0.8929. Check. 0.6355, 0.5674. Very easy question, so I am doing little fast. Now multiply 1200 into factor. Check the answer, 178.57. 100 into factor, 63.55. 400 into this factor, 226.97. Take the total. Anybody who is getting 469.09, please confirm. 469.09. 469.09 is right. Say yes or no. Okay. Now multiply year column and present value column. 178.57, 4 into 63.55, 254.20, 5 into PV, you will get 1134.85. Yes, please confirm this total. 1567.62. How many of you got it? Just say yes. Those who are attending online will say yes, you've got it. So therefore, duration is equal to 1567.62 divided by 469.09, 3.34 years. If duration of liability is 3.34 years, the duration of the bond portfolio should also be 3.34 years. But we have two bonds, two zero coupon bonds, so we have to find what should be the weight of bond X and bond Y so that your overall portfolio duration comes to 3.34. So write a small note first, although not required in the exam, but right now for understanding we will write everything. Note, write down first point, the principle of immunization requires that. The principle of immunization requires that the duration of asset should be equal to duration of liabilities. The duration of asset should be equal to duration of liabilities. The principle of immunization requires that duration of asset should be equal to duration of liabilities. And second thing, you already know, duration of a zero coupon bond, duration of ZCB is equal to their maturity. So what is the duration of this liability 3.34. So I have to invest in two bonds, X and Y. Suppose I invest an amount W in first bond, then I will invest 1 minus W in the second bond, and the duration of first bond will be 1 year and duration of the second bond will be 7 years, and the weighted average duration should be equal to 3.34. The weighted average duration will be equal to 3.34. So you will have to solve the equation and find out how much should be the weight of bond X and how much should be the weight of bond Y. So we'll write down nicely, write down calculation of, below that write down calculation of proportion of funds, calculation of proportion of funds to be invested in the two bonds. Calculation of proportion of funds to be invested in the two bonds. You are writing as exam answer, you have to write the heading first, write the equation, put the values, and then solve and get the values of X and Y. So students, please try, don't copy the answer. Wx means weight of X into dx, weight of Y into duration of Y is equal to duration of liability. So we are going to use this equation one or two more times in today's lecture. Weight of X into duration of X is 1, weight of Y will be 1 minus weight of X. There are only two bonds, so weight of second one will be 1 minus weight of the first bond into 7, and that is 3.34. So I am going to simplify it. This will become Wx, this will become plus 7 minus 7Wx and is equal to 3.34. So please check the answer. This is so simple that you should be able to do it very fast. Is the answer Wx equal to 0.61? Please confirm. Is the answer 0.61? And is the answer 0.39? Devika, Divya, is the answer right? Hari, okay. So approximately, if you are getting these two numbers, enjoy, you are right. So it means 61% amount should be invested in the first bond and 39% amount should be invested in the second bond. So this is the percentage investment. Now we have to compute the amount to be invested. Now write down below amount to be invested in bond X. Amount to be invested in bond X will be 0.61 into present value of the liability. 0.61 into present value of liability. This present value of liability we have computed in step 1. So that is coming to 286.14 lakhs. So today we will invest 286.14 lakhs. Similarly, write amount to be invested in bond Y. Amount to be invested in bond Y is equal to 0.39 into 469.09 into 469.09 is equal to 182.95 lakh. This today we are going to invest this amount in bond X and bond Y. This amount reflects the present value of the face value. All of you have studied PV of zero coupon bond is face value into 1 plus R to the power n. So my next question is, what is face value? So face value of the zero coupon bond will be present value into 1 plus R to the power n. So write down below price of ZCB equal to price of ZCB equal to face value upon 1 plus R to the power 1. Therefore, we can write like this: face value is equal to price of ZCB into 1 plus R to the power n. Solve. Face value of bond X will be equal to, take the amount from here, 286.14 into 1.12 to the power 1 into 1.12 to the power 1, and this comes to 320.48 lakhs. 320.48 lakhs, and then write down face value of bond Y. Face value of bond Y. Take this amount into 1.12 to the power 7 now. Into 1.12 to the power 7. So please solve. The face value of this zero coupon bond Y will be 404.44. 404.44. Is it right? So we have answered 3 questions: proportion, amount to be invested today, and what will be the face value. But there is a question pending: give the proof of immunization. So suppose after investing in the bond, the market rate goes down to 10%. Are we still in a position to pay our liabilities as we had planned? We have to prove that. So please write down proof of immunization. This they will not ask in the exam, but this is for your benefit. Usually not asked. Usually not asked in the exam. So write down proof of immunization. First scenario 1, interest rate in market goes down to 10%. We have taken current market rate 12%. Let us say after you have purchased the bond, the market interest rate goes down to 14%. Immediately after investment in the bond portfolio. Immediately after investment in the bond portfolio. So what will happen now? The value of the bonds will change. The value of the bonds will change, and the whatever cash flow you have, that can be reinvested at 10% rate of interest. So first we have to see what are my liabilities. I have 3 liabilities. One is payable after year 1, one is payable after year 4, and one is payable after year 5. Okay, so write down bond X matures and pays face value, and bond 1 also has 1 year maturity. So what will happen to this bond X? Bond X will also mature, and you will get an amount equal to its face value, because if the maturity is 1 year, on maturity date bond X will give you 320.48 lakhs, and out of that you will pay the first liability 200 lakhs, and remaining amount you will reinvest. Remaining amount you will reinvest at the rate of 10%. So please write bond X matures and pays face value. So what happens at the end of year 1? You will receive the amount from the first bond X, amount received from bond X. Bond X will mature and you will receive 320.48. At the end of year 1, you have a liability to be paid 200 lakh. You have a liability to be paid 200 lakh. So what is the cash flow remaining with you? The cash flow remaining with you will be, right, 120.48 lakhs. 120.48 lakhs. Now, this 120.48 lakh will be reinvested at the rate of 10%. When is my next liability? My next liability is after 3 years. Next liability is at the end of year 4. we are standing at the end of year 1, so my next liability will be after 3 years. So this surplus which I have, I can reinvest at the rate 10% per annum for 3 years. So write the remaining amount 120.48, the remaining amount 120.48 is reinvested at 10% per annum. Is reinvested at 10% per annum for 3 years. Is reinvested at 10% per annum for 3 years. Now let us come to end of year 4. This amount at 10% interest rate after 3 years will become some amount. From that we will pay the liability of the 4th year, which is 100, and we will see how much surplus do we have. So please write right hand side rupees in lakhs. First point A, amount received from investment. This 120 invested for 3 years at 10% will give you how much? Just try on your calculator. 120.48 into 1.10 to the power 3 will give you 160.36 minus liabilities paid 100. The 4th year liability is 100. So you are left with remaining amount 60.36. Very good. So what will you do with this amount? Please reply. This amount will be reinvested for how many years? This amount will be reinvested for how many years? And at what rate? Yes, reply. Divya. Other students, only 1 or 2 students are replying. This amount will be reinvested for how many years? So when is my next liability? My next liability is at the end of year 5. So we will invest it for how many years? We'll invest it for 1 year. Correct. We'll invest it for 1 year at 10%. Because the next liability will fall due at the end of year 5. We are standing at the end of year 4. So the gap is 1 year. So write down next line. At the end of year 5, what will happen at the end of year 5? You are going to redeem the amount invested 60.36 into 1.10, and you are also going to sell bond Y. First write down right hand side rupees in lakhs. Write very nicely, because this will convince you that this immunization scheme works. First point A, amount received from investment. 60.36 into 1.10. 60.36 into 1. Please check. 66.40, is it right? 66.40, is it right? Then sale of bond Y. Bond Y have a face value of 404.44, which we have computed earlier. This bond will mature in the 7th year and we are standing in the 5th year. So if I sell this bond, I will have to sell it by discounting it for 2 years at 10% discount rate, because the market rate is 10%. So I will take the face value of this 7-year ZCB, divide by 1.10 to the power 2, because the gap between today and maturity is 2 years. So check the calculation. Are you getting 334.25? We are standing here. Bond Y will mature here. You will get 404.44. So discounted by 2 years at 10%. So total amount you will have, total amount One by selling your investment and second is selling your bond by, you have 400.65 less liabilities paid, less liabilities paid, less liabilities paid. You see the question book, fourth question book, fifth year liability is 400 rupees. Therefore balance 0.65, 0.65, very small amount, which is almost close to zero, which is almost close to zero. So therefore you are able to pay all your liabilities even though the market interest rate has gone down. Okay. Now this is the situation when interest rates have gone down in the market. The student will say, what happens if the interest rate goes up? Suppose interest rate in the market goes up from 12 to 14%. Will I still be immunized? Will I still be immunized? Yes, let us see. So write down scenario 2. Write scenario 2. Scenario 2 is suppose interest rate in the market goes up to 14%. So I will take higher rate now, immediately after investment in the bond portfolio. Let us say rate goes up. Same process will follow. Exactly same process will follow. You can also try yourself. At the end of year 1, what happens? Bond X matures and pays face value. And at the end of year 1, the first liability of 200 lakh also matures and we have to pay. So write down amount received, because if bond X will mature, you will get an amount equal to face value. Right hand side rupees in lakhs. Amount received from bond X. Amount received from bond X. Amount received from bond X 320.48 less liabilities paid, less liabilities paid, less liabilities paid 200. So therefore what is the remaining amount? 120.48. This amount we will invest for 3 years. At what rate? At the rate 14%. This amount will reinvest for 3 years because next liability is due after 3 years. So we'll invest it for 3 years at the market rate of 14%. Okay. Up to this is right. Say yes or no. Up to this is right. So right. The remaining amount, yes, keep replying. Okay, keep replying. Everybody, the remaining amount 120.48 is reinvested at the rate 14% per annum for 3 years. The remaining amount 120.48 is reinvested at the rate 14% per annum for 3 years. So now let us come to year 4. After 3 years are over, the value of this investment will become 120.48 into 1.14 to the power 3, and that we will use to pay the liabilities. Right hand side rupees in lakhs. Right hand side rupees in lakhs. First point A, amount received from reinvestment. Amount received from reinvestment. Amount received from reinvestment in bracket write 120.48 into 1.14 to the power 3. 178.50 you are getting? Say yes, 178.50. And what is the liability to be paid at the end of year 4? The less liability to be paid 100 given in question. So remaining amount, therefore remaining amount remaining amount is 78.50. Remaining amount is 78.50. This amount you will invest for how many years? Please reply. This amount you will invest for how many years? 1, 2 or 3? 1 year. Very good. At what rate? At what rate? 10, 12 or 14? At what rate? 10, 12 or 14? 14%. Very good. So we are going to reinvest this amount at 14% for 1 year. So right below, the remaining amount will be reinvested. The remaining amount will be reinvested for 1 year at 14%. The remaining amount will be reinvested for 1 year at 14%. Now write down at the end of year 5. Same method will do. We'll realize the investment, we will sell the bond Y. So first right hand side rupees in lakhs. Right hand side rupees in lakhs. Point number A, amount received from reinvestment. This amount was invested for 1 year. So you will get 78.50 into 1.14. Calculator ready. 89.49. Then we will sell bond Y. The maturity of the bond Y is 7th year, but we are going to sell it at the end of 5th year. So we will be able to sell at the present value of this face value by discounting it by 2-year factor, and the discounting rate will be 14%. So write down 404.44 divided by 1.14 to the power 2. Student will reply, is it right? 311.20. So tell me the total now. The total cash flow you will have is A plus B 400.69. But how much liability you have to pay? You have to pay a liability of 400. Therefore balance 0.69, almost zero. It cannot be zero. Sometimes it can be zero also, but it is irrespective of whether the market rate has gone down to 10% or gone up to 14%. You are finding that you are close to zero after 5 years, which means you are able to immunize your liability by investing in bonds when the duration of the bond portfolio is equal to duration of the liabilities. So these two examples were given to prove, to convince you that this is how the immunization strategy will work. Now we'll come to question number 65. This is not 65. This is 67. Where is 65? 65 is not typed only, no problem. Ignore. Okay, 64, my mistake. This is 64. 64 got typed 2 times, so I got confused. So this number is 65. Next question is 65. Student, please correct. In your book you will find 64 got typed 2 times. So the next question number, write down 65. If it is like that. Consider an investor with the following stream of liabilities. Year and liabilities amount. Year 2, 3, 5. Liability amount 60,000, 40,000, 50,000. The opportunity cost of fund is 10%. He wants to invest in a bond portfolio such that his liability is immunized. Following 2 bonds are selected. Bond X 1 year 0 coupon bond yielding 10%. Bond Y 7% 0 coupon bond yielding 10%. Calculate the proportion of funds to be invested in this bond. This time you don't have to prove anything. we just need to find out the proportion to be invested in bond X and bond Y. Same problem, just one more quick practice. Step 1 will be finding the duration of liabilities. Write down. Step 1, this is for extra practice. Calculation of duration of liabilities. Calculation of duration of liabilities. Year, amount, discounting factor at 10%, present value into year, present value into year. So year, write down 2, 3 and 5, 2, 3 and 5, and the amount is 60,000, 40,000, 50,000. So tell me the discounting factor at 10%, write it down, multiply, get present value, complete yourself. I will check after 5 seconds. Complete the table. Check the answer now. Please confirm. Are you getting 1,10,681? Please confirm. Online student, please confirm. Last column, 344, 549. Is it right? Everybody please reply yes. So which means duration is equal to, in case if you have not got it, please just note down these numbers. Later on you can check it. Same problem we are doing, so will not take much time. Duration is equal to 344549 divided by 110681. So that comes to 3.11 years. Okay. And now what I have to do? I have to invest in two bonds, X and Y, and their duration should also be 3.11 years. So write a note. The principle of immunization requires that the duration of the assets should be equal to duration of liabilities. Duration of the asset should be equal to duration of the liabilities. Duration of the asset should be equal to duration of the liabilities. And second point write down, duration of zero coupon bond is equal to their maturity. Duration of zero coupon bond is equal to their maturity. Duration of zero coupon bond is equal to their maturity. Same question, one more time, write down. Calculation of proportion of funds to be invested in the two bonds. Calculation of proportion of funds to be invested in the two bonds. Like the previous question, write down weight of X into duration of X plus weight of Y into duration of Y is equal to duration of liabilities. Okay, then write down weight of X. You can write slightly like this, weight of X into 1, because zero coupon bond has same duration as maturity, plus weight of Y will be 1 minus WX into 7, and that is equal to 3.34. So if you multiply this, you get WX 7 into 1, 7 minus 7 Wx is 3.11. 3.11. So solve. Please confirm whether you are getting same proportion. Just confirm please. All of you, those who are online student, please confirm you are getting same response. Is the answer right? Okay, so the answer is right. Now we'll come to question number 66. Only they had asked proportion, so I have answered proportion. If they ask you to write amount, you can do it. If they ask you to write face value, you can do it. If they ask you to do proof also, you can do it. But we are not doing because we have already done in question number 64. In the same way, you can do it. Now we'll take a little advanced version of the same question. Question number 66. The following corporate bonds are considered for investment by the portfolio manager. His aim is to immunize the liability due in 6 years. So what is the duration of liability? 6 years. So this time you don't have to calculate the duration of liability. It is given to you. Say thank you. Thank you, sir. You saved our one step. Now next is all bonds have a face value of rupees 1000. So this time I have given you 3 bonds ABC. Their maturities are given, coupon rate is given, and they have also given you the duration of these 3 bonds. So you don't have to find out separately duration of these 3 bonds. That is also done for you. Question is, if the portfolio manager wants to invest 50% in A, so 0.5 in A, whose duration is 7.35, what is the percentage of total amount that can be invested in the other 2 bonds to immunize the portfolio? Other 2 bond means bond B and bond C. Total weight of the portfolio is 1. 0.5 is invested in A. So 0.5 will have to be invested in B and C. 0.5 will have to be invested in B and C. So now the student will reply, I will wait for your answer. What should be the weight of B and C so that the portfolio duration is 6? So that the portfolio duration is 6. So if you assume weight of B as X, it will be X into 6.15, and weight of C will be 0.5 minus X into 4.30 into 4.30. So if you solve this equation, you will get the value of X, and when you get the value of X, it will give you value of or the weight of bond B. Weight of bond C will be balancing figure. Is it right? If there are 3 bonds, usually they will give you weight of first bond or any bond. Take the balance weight. That balance weight you have to apportion between other 2 bonds. You please try. I will wait. What is the weight of bond B and bond C? Come on. What will be the weight of bond B and bond C? Some details are not required in this question, like the coupon rate is not required. Any student who can give me the weight of bond B and bond C? Yes, any answer? Please reply fast. Okay, now you write down the answer and check it if you have done. Let the weight of B Limited be W1. Let the weight of B Limited be W1 and weight of C Limited be W2. And weight of C Limited be W2. Weight of C Limited be W2. Weight of A Limited is already 0.5. Have you got the answer? Anybody? You can just student who are attending online can type on in the chat box. Have you got the answer? So now write down weight of 1 plus weight of 2 should be 0.5 and therefore weight of 2 will be 0.5 minus W1. For immunization, you have to write down the answer in detail, not just one line, but everything you have to present to get full marks. Duration of asset portfolio should be equal to duration of liability portfolio. Okay. So what will be the equation now? Don't write this table, not required. Don't write the table, not required. The equation will be 0.5 into 7.35 plus 6.15 into W1 plus 4.30 into W2, and that is equal to 6, which we can simplify as 6.15 W1 plus 4.30 W2, and this amount is 3.675, so I will deduct it from 6, so I will get 2.325. okay, now I will again simplify it for you. 6.15 W1 plus 4.30 into bracket 0.5 minus W1, this we have discussed, is 2.325. Further simplify and solve. Anybody who can confirm, is it right? Weight of first security, weight of B is 0.095, is it right? Yes, very good. 0.0945 is also okay. This is also okay. And what will be the weight of second or the bond C? 0.5 minus previous answer, this answer. If you have got 0.095, right, no problem. So your answer is close to 0.405. Very good. So finally we got the weightage of all the three bonds. Bond A is already 0.5. Bond B should be 0.095 or 0.0945 and bond C will be 0.405. So write down the summary portfolio mix. So what will be my portfolio mix? In order to immunize the portfolio, I will invest in three bonds A, B, C. A's weight will be 50%, B's weight will be 9.5% and C's weight will be 40.5%. If you make a summary, it looks nice. Okay, so institute will check these figures. If this is right, your answer is right, and you walk away with 4 to 6 marks for such simple easy question. Now we'll take question number 67. Question number 67. Source is a reference book. I have taken some question from reference book for extra practice. A company has to pay rupees 1 million at the end of each of 3 years. So this time again you have 3 liabilities. You have to pay 1 million, 1 million, 1 million at the end of year 1, year 2, year 3. The company wants to fund this obligation today when the current interest rate is 10%. So you have to first compute present value of the liability by using 10% discount rate. So I will get present value of liability. Two zero coupon bonds have been traded in the market. Two zero coupon bonds, 1 year maturity and 5 year maturity. So duration is equal to 1 year. Here duration is equal to 5 year. Suggest the interest rate risk immunized investment plan, which means percentage of funds to be invested in bond A and percentage of funds to be invested in second bond, so that the duration of the liability is equal to duration of the bond portfolio. So similar to the earlier question, just presented in a different manner. So what are my steps? First step I will calculate. First step I will calculate. First step would be, right, first step would be present value of liability, and second step will be, we'll calculate the weights of the two bonds. Okay, so right, step 1, calculation of present value and duration of liability. Calculation of present value and duration of liability. Calculation of present value and duration of liability. Same format, year, amount in million, discounting factor at 10%, present value into year, present value into year. So please solve. Solve yourself, come on everybody. First year column 1, amount is 1 million. Discounting factor at 10% will be 1 divided by 1.10.909. Present value will be same, 1 into 0.909, and year into present value will also be same. Year 2 write down. Again amount in million 1. Second year factor 0.826. PV 0.826 and PV into year is 1.652. 1.652. Then write year 3. Year 3 write amount 1 million, factor present value into year. Okay. Calculate the total of the last two columns. This amount is the present value of liability. Total of the last column divided by total of this column will give you duration of liability. So duration of liability is how much? 4.814 divided by 2.486. So that is equal to 1.94. That is equal to 1.94. Then write down below duration of a 1 year zero coupon bond. Duration of a 1 year zero coupon bond is equal to 1 year. Duration of a 5 year zero coupon bond, duration of 5 year zero coupon bond is equal to 5 years. Duration of 5 year zero coupon bond is equal to 5 years. So you have to find out the weight of these two bonds so that the duration of the bond portfolio is 1.94. So can you please try? What should be the weight of these two bonds? Next line, write down total investment to be made today. Total investment to be made today will be the same amount, that is present value of liability, 2.486. 2.486. Okay, is it right up to this point? Up to this is right, everybody? Any query on this? Any query? Okay, no queries. So write down below, investment should be made in such a ratio, investment should be made in such a ratio that the duration of the bond portfolio is 1.94, that the duration of the bond portfolio is 1.94. So write below, let us invest W1 in year 1. Let us invest W1 in year 1 maturity bonds. Let us invest W1 in year 1 maturity bonds, and 1 minus W1 in year 5 maturity bonds, and 1 minus W1 in year 5 maturity bonds. So please solve this equation. Check whether equation is right. Please check whether the equation is right. I'll just come in 5 seconds. Please do it. Okay, have you got the answer? Have you got the answer? What is the answer for W1? Very good, 0.765. And the amount to be invested, in 1 year maturity amount to be invested in 1 year maturity is 0.765 into 2.486 into 0.2.486 is 1.90179 million. Okay, and now you tell me one thing more, write down. 1 minus W1, how much you got? 1 minus W1 was 0.235. Investment in 5-year maturity. Investment in 5-year maturity is 0.235 into 2.486. Come check the answer. 0.58 0.58421 0.58421 0.58421. Okay, so this way the answer is we will invest this amount in first bond and this amount in second bond. This will result into our bond being immunized or liability being immunized from fluctuating interest rate risk. Okay, so that was one more practice. Now we'll take a little different problem. So one practice we did is the proportion of the funds to be invested in 2 bonds or 3 bonds, so that the duration of liability and duration of bond portfolio is equalized. And with the help of 2 examples we have proved that how the immunization scheme works. So now the student will come to an important exam question. Write down, very important. This question has come in November 15 exam, November 21 RTP, MTP March 2022. We will solve in the notebook. All of you will solve in the notebook. Mr. A will need rupees 1 lakh after 2 years. So duration of liability is 2 years. Only one liability means whatever is the maturity date of the liability is your duration of liability, for which he wants to make one time necessary investment now. He has a choice of 2 types of bonds. Their details are as follows: bond X, bond Y, face value, coupon rate 7% payable annually, 8% payable annually, years to maturity. This is a 1 year maturity bond, this is a 4 year maturity bond. Then current market price is also given. This is their current market price, and current yield is written here. Actually they should have written here YTM, because current yield has a different meaning and YTM has a different meaning. So it should be YTM. Anyway, we will treat it as a discount rate. We will treat it as a discount rate to calculate the duration of the bond. Advise Mr. A whether he should invest all his money in one type of bond or he should buy both the bonds. So whether he should invest only in X, only in Y, or in both the bonds. What is your view? Should he invest only in X, only Y, or both? Anybody? First we'll check the duration. If duration of any of these bonds matches with 2 years, then we can invest in that particular bond. But if the duration of any of these 2 bonds is not equal to 2 years, then we'll have to invest in both the bonds such that weighted average duration is 2 years. Okay, so the answer is we will have to invest in both the bonds. And then the question is in which quantity. This is a new question. Which quantity means number of bonds you have to find. And for finding the number of bonds, they have given you the current price of the bond. So we will compute amount invested in each bond divide by current price of one bond. That will give me quantity of each bond. Okay, and assume that there will not be any call risk or default risk. That means assume that all cash flows will be paid as promised. So what I need to do, first I will have to find the duration of these two bonds. These are not zero coupon bond. These are coupon paying bond. So in coupon paying bond, we have to compute the duration by applying either the tabular format or by applying the formula. But if it is a bond with only 1 year maturity, if it is a bond with just 1 year maturity, then whatever cash flow you will get will be at the end of year 1, and therefore no need to calculate for a 1 year coupon bond also, because 1 year coupon bond also will have a duration of 1 year. So start. Step 1, duration of bond X, duration of bond X, duration of bond X, duration of bond X. As bond X has only 1 year to maturity, as bond X has only 1 year to maturity, duration will be 1 year. Duration will be 1 year. As bond X has only 1 year to maturity, duration will be 1 year. Then write down duration of bond Y. This we have to compute. This we have to compute by preparing a tabular format. Year, cash flow, discounting factor at 10%, and PV into year. It is a 4-year bond. It's a 4-year bond, right? 1, 2, 3, 4. Cash flow of bond Y will be 8% of 1080 rupees for first 3 year, and in the 4th year you will get 80 plus 1000. 80 plus 1000 is how much? 1080. Okay. Now again please solve, all of you, and give me the total of these two columns, PV column, last column. Try yourself. Please reply. What is the present value? Please answer. What is the present value? Anybody getting 936.50? Very good, Divya. Amazing. Tell me the total of last column also. Other student also can reply. Total of the last column. Total of the last column. 3335.824. Check. Is it right? So duration will be equal to, take your last column total, divide by PV. So this is another benefit of learning duration. You can find out how much proportion should be invested in the two bonds to immunize your portfolio from changing interest rate risk. So is it 3.562 year? Is it 3.562 year? This bond has 1 year. This bond has 3.562 year. So weight of X into 1 plus weight of Y into 3.562, and that should be equal to 2 year. That is the duration of liability. So can you please tell me now what would be the weight of X and Y? So write down next heading. Next heading, write down. See, we have to also present the answer nicely in the exam. Only just reaching the answer is not enough. It's 8-mark question. So you may get just 5 marks if you don't present it properly. you can get full 8 marks if you present it very properly. That is the difference between your rank holding and not rank holder. So calculation of proportion to be invested in each bond. Calculation of proportion to be invested in each bond. Then write down, let investment in bond X and bond Y. Let investment in bond X and bond Y be W and 1 minus W respectively. W and 1 minus W respectively. So I am going to write the equation and you will solve. W into 1 plus 1 minus W into 3.562 is equal to 2. Please solve and give me the answer. Please solve and give me the answer. Is W equal to, check the answer yourself, is W is equal to 0.61. Is W equal to 0.61? Very good. 0.609 is also right. One student got 0.609. This is right. An investment in bond Y will be 1 minus 0.61, that is 0.39. If you have written 0.609, accordingly change this. Answer question is not over. It says, in what quantity you will buy bond X and bond Y. What you have got is proportion, and we have to also write quantity. So which means 61% of the present value of liability will be invested in bond X, and that will be divided by the current price of the bond 972.73 will give you quantity of the bond. So please write down next heading, this line, amount to be invested in bond X. Amount to be invested in bond X. Amount to be invested in bond X. The liability amount is 1 lakh. You will invest 61%, and this is for computing the present value. So 1 lakh divided by 1.10 to the power 2 will give you present value into 61% will give you the amount to be invested today. So please students check this number. Is it 50413? And in the same way, take 1 lakh into 39% divided by 1.10 to the power 2. So basically 1 lakh divided by 1.10 to the power 2 is the present value of liability into 39% is the amount to be invested in bond Y. So that comes to 32231. 32231. Therefore write down number of bonds to be purchased. Next heading, write down number of bonds to be purchased. You will answer. This amount you have to invest in bond X divide by 972.73. This amount you have to invest in bond Y divide by 936.52. So anybody, how many bonds you will buy for X and how many bonds you will buy for bond Y? Any student? 50413 divided by 1 bond price. So write down the answer, number of bonds to be purchased. Anybody got the answer? Reply fast. X will be equal to, this is the amount invested, this is the current price of 1 bond. So that comes to 52 bonds approximately. Check. 52 bonds. Is it right? And Y write down 32231 divide by 936.52 is 34 bonds approximately. So this is a question where they have also asked you to find out quantity of bonds, and there is one more question there. Last line of the question, assume that there will not be any call risk or default risk. Okay, and in whether you will invest in one bond or both the bonds. Now you can't invest in only one bond because the duration of bond X and duration of bond Y individually is not equal to 2 years, which is my duration of liability. Therefore you can't invest in only one bond, otherwise your liability will not be immunized. So we will write the investor has to keep the money invested for 2 years. The investor has to keep the money invested for 2 years. The investor can invest in both the bonds. The investor can invest in both the bonds, or you can say he should invest in both the bonds. He should invest in both the bonds. Bond X will be reinvested for another 1 year. Bond X will be reinvested because bond X has 1 year life, so you can reinvest for another 1 year on same return. Bond X will be reinvested for another 1 year on same return. Individually you cannot invest in bond X because duration will not match. Okay, so is it right? Any query? Anybody any query? Say yes or no. No query? Can we go ahead? Another question, write down, very important. Question number 69, taken from your November 2018 exam, and this question is likely to be repeated in the exam. Very important. Tick mark. Trust me. The following data are available for 3 bonds A, B, C. These bonds are used by a bond portfolio manager to fund an outflow scheduled in 6 years. So what is the duration of liability? Duration of liability is how many years? Come on, 6 years. Current yield is 9%. All bonds have face value of rupees 100 each and will be redeemed at par. Interest is payable annually. There are 3 bonds. These are the maturity years. These are the respective coupon rates. So this 9% I will use as a discount rate here for finding the present value of each bond and duration of each bond, right? So first question is, like the previous problem, you have to find the duration of each bond. So that will take a lot of time, very time consuming question, because these are all coupon bonds and the life is also 10, 8, 5. So you will have to work hard and get the duration. Second, the bond portfolio manager has asked to keep 45% in A. So weight of A is 0.45. Weight of B and C you have to find. Calculate the percentage amount to be invested in bond B and C so that the portfolio is immunized. So this you can assume W. This you can assume 0.55 minus W, because first bond is 0.45, B plus C will be 0.55, so C will be 0.55 minus W, same like the one I had solved earlier. after the portfolio has been formulated, the interest rate changes occurs, increasing the yield to 11%. So yield has increased, YTM has increased, the new duration of these bonds will be. So good thing is that now they have computed the duration of bond A, B, C themselves. Otherwise you would have been required to compute. Is the portfolio still immunized? Answer is why or why not. So with the revised duration, we will check what is the duration of the portfolio. Is it equal to 6 years? If it is not equal to 6 years, then we will say our portfolio is not immunized because duration of the portfolio bond is not equal to duration of liability. So very simple question. If it is equal to 6, the answer is yes. If it is not equal to 6, the answer is no. If suppose your answer is no, determine the new percentage of bond B and C that are needed to immunize the portfolio, bond A remaining 45%. So just you have to do reworking. Bond A will be 45, bond B and C you have to find out with the help of this revised duration. So very simple question. Now you can compute the duration of bond in two ways. One is by preparing the tabular format and second is by applying the formula. Okay, we have already solved so many questions by tabular format. So let us try and solve by formula method and see whether we get the same answer. The institute's answer is presented in the book. I am just solving it by formula method. Okay, you can solve by tabular format also. So first heading write down bond A. Bond A present value is equal to present value is equal to 10 into PV annuity factor, 10 into PV annuity factor in bracket 9% comma 10 year plus 100 into PV factor (9% comma 10 years. Yes, please reply. If you think this is simpler, you follow this. If you think tabular format is simple, please go ahead and follow that. So 10 into the factor for 10 year and 9% is 6.4176 plus 100 into 0.42241. So the present value of this bond will be equal to 106.417. Please check. And if you look at the institute answer below, so they have also got the same answer. Now write down current yield. Current yield is equal to current yield is equal to 10 divided by 10 rupees the coupon, 106.417 is the price. So that is 9.4%. Current yield is equal to 9.4%. Current yield is equal to 9.4%. Now you know the formula of duration. So I am just trying to revise one more time the formula of duration. Duration is equal to current yield upon YTM. In the question there is a small drafting mistake. They have written current yield is 9%, but they should have written YTM is 9%. They should have written YTM is 9%. So current yield upon YTM into PV annuity factor in bracket YTM comma N into 1 plus YTM plus 1 minus current yield upon YTM into N. Okay. I want the students to solve and give me the answer. Please try and give me the answer. So current yield is 9.4 divided by YTM 9 into PV annuity factor 9% comma 10 year. So this is already calculated here, PV factor into 1 plus 0.09 plus 1 minus 9.4 divided by 9 into 10. So the answer will be, anybody answer? Come on. The answer is how much for this bond A? The answer is approximately 6.86 years. 6.86. Check, is it right? All the students please check, is it right? 6.86 years. Even in the tabular format, if you see, the answer is 6.86 years. Both are right, whichever comforts you, follow that. Then come to bond B. Bond B, write down present value is equal to 11 into PV annuity factor. 11 is the coupon amount into 9% comma 8 years. 9% is the YTM, 8 is the year, plus 100 into PV factor. So what is the answer here? What is the answer here? Present value is equal to how much? Present value is equal to 111.06898. Is the answer right? 111.0698. Now current yield, write down. Current yield will be annual coupon divided by current price. So that is 1111 divided by 111.0698. 9.9%. Now again try. Let us see who will give the answer first. Yes, Hari, Devika, Divya, other students. What is the duration of this bond? What is the duration of the bond? So first you put the numbers, then you simplify. Answer is equal to around 5.84 years or 83 years. 5.83 or 5.84. If you refer the answer given in your notes, even the institute's answer using tabular format is same. So both will give you same answer. Is it right now? Bond B. Can we go to bond C now? So bond C is very easy. I will tell you why. Come to bond C. Now if you look at the bond C carefully, coupon rate is 9%, YTM is 9%, bond will be redeemed at par, bond will be therefore trading at par. So no need to calculate. So using your knowledge of bond, that if the coupon rate and discount rate are same, redemption is at par, the present value of the bond will be equal to face value of the bond. So write down just one line, the coupon rate is equal to YTM, therefore bond is trading at par. Therefore, bond is trading at par. And remember one shortcut formula for duration. If bond is trading at par, current yield will also be equal to 9%. So current yield upon YTM will be 1. So there is no need to write 1. There is a shortcut formula for duration. Oh, there is a shortcut formula for duration only when the bond is trading at par. Only when the bond is trading at par. So now see the benefit of using this method. For third bond, I won't have to invest much time. Even for calculating present value or even for calculating duration, I can apply shortcut formula only when the bond is trading at par. So write down PV annuity factor 9%, 5 into 1 plus YTM, which is 1.09. So if you are alert, sometime you can save time. Yes, answer please. Who will reply fast? Answer of bond C is 4.24 years. 4.24 year and the present value is 100 rupees. So we have answered part 1 of the question. It's a long question. Compute duration of each bond. Now the next question is percentage amount of investment required in bond B and bond C. Percentage amount of investment required in bond B and bond C. They have already given that in bond A you will invest 45%. So right, amount invested in bond A is 0.45. Hence amount invested in bond B and C, together will be 1 minus 0.45, which is 0.55. So you will write let weight of bond B be WB. Weight of bond B be WB. Therefore, what will be weight of bond C? Therefore, weight of bond C will be 0.55 minus WB. 0.55 minus WB. So can I ask you to solve the equation now? In order to immunize the portfolio, duration of asset is equal to duration of liabilities. So I'll give you an equation and you will solve. Duration of asset equal to duration of liabilities. So I'll give you an equation, WA into DA plus WB into DB plus WC into DC, and which is equal to 6. Put the numbers and solve. I will expect that this time you will reply. I'll wait 30 seconds. I will wait. Anybody can tell me what is the answer? What is the answer? WB is equal to how much? Check. WB is equal to how much? Is it 0.3631? Say yes. Yes. So what will be WC equal to? WC will be equal to 0.55 minus 0.3631. 0.55 0.1869. 0.1869. Yes, please reply. Is it right? Is it right? Okay. Now write down answer of part 3. What happened in part 3? The duration have changed. If the duration has changed, with the same weight, if I go ahead, we will check whether duration of portfolio will be same or different. Okay. So write down calculation of revised portfolio duration with revised yield. YTM got revised, so duration has changed. So what will be the duration of the portfolio of the 3 bonds with the same weight we have computed but revised duration? Write down revised portfolio duration will be equal to weight we will take from previous answer and duration will take from the question book they have done. So 0.45 into 7.15, 7.15 is given, 0.3631 into 6.03 and plus 0.1869 into 4.27. Weight I will take from our calculated answer, revised duration they have done for individual stock. So the answer is, yes, please answer, 6.205. So now reply whether your portfolio is still immunized, whether your liability is still immunized. The liability will be paid after 6 years, but your portfolio duration is 6.205. So is it still immunized? Yes or no? Is it still immunized? No. You are right. Very good answer. So therefore, you will have to change the weights again. You will have to change the weights again. First write a note. No, portfolio is not immunized. No comma. Portfolio is not immunized. Portfolio is not immunized as the duration of the portfolio, has increased from 6 years to 6.2 years. Has increased from 6 years to 6.2 years. Then write down, you have to again compute the revised weights. Answer of part 4. Again we have to repeat the same equation. New percentage of bond B and C, new percentage of bond B and bond C that are needed to immunize the portfolio, So same equation write down, but the duration will be based on the third question. Weight of A 0.45 into duration 7.15 plus weight of B. Duration of B has changed to 6.03 plus weight of C, which is 0.55 minus WB into 4.27 is equal to 6. Solve. Let us see who can solve it first. Yes, please solve. Anybody who is able to solve? What is weight of B? Come on, weight of B 0.2466. 0.2466. Check if it is right, say yes. If it is right, say yes. Is it right? So what will be weight of C? weight of C will be 0.3034. 0.3034. That was a very easy question, but if you have practiced well in advance, you can do it. These are the type of questions you can get in the exam again. So these were a few questions on interest immunization. Now the next big part of this chapter is option embedded bond. What is the meaning of option embedded bond? Embedded means something which is attached to a bond. So option embedded bond means it is not a straight bond. It is a bond which has got some option embedded in it. That means along with the bond, there is an option also attached to it. So example, convertible bond. So how it is an option embedded bond? It means that you will not only get the bond, you also get an option to convert the bond into equity share. So the option to convert into equity share is an option which is embedded in the bond. The other example is callable bond. Callable bond means the bond with call option. It is a bond plus the company which has issued the bond has an option to call back the bond before the maturity date. Company can call back the bond before the maturity date. That option is with the company. Is it right? And then putable bond. Putable bond means here the bond plus an option to surrender the bond before maturity is with the investor. If the investor wants, he can surrender the bond before maturity. And there is one more extendable bond which has an option to extend the maturity of the bond. We'll discuss all of this, so I'm not writing. So company has issued a bond for 5 years, but if it wants, it can extend the maturity of the bond to 10 years. So it's like opposite of callable bond. In callable bond, they can reduce the maturity of the bond and redeem the bond. In extendable bond, the company can extend the maturity of the bond. So how to value these bonds? What are the important features of this bond? What kind of questions we can expect on this topic? That is what we will see. So our next task is convertible bond or convertible debenture. So this you have already studied in your accountancy classes. Convertible debenture bonds means, or bonds or debenture means, these are the bonds or debenture which will be converted into specific number of equity share, a certain number of equity share within a certain specified period. So company usually gives an option to the investor that on or after this date you can get your bond converted into equity share, right? So that kind of bond is called convertible bond. What is the benefit of issuing convertible bond? Company is able to give some incentive to the investor to invest in the bond. The investor will be able to get equity share at some predetermined value or certain predetermined number of equity share. So if the company is good and the price goes up, then he will get a huge benefit. And suppose the price goes down, he can get the face value of the bond. So either he will opt for face value of the bond on maturity, or he will opt for the equity share, whichever has a higher value. So that helps the company to market the bond to the investor. And to the investor also it is an advantage, because if you invest 100 rupees in a bond and it gives you an option to buy equity share on maturity, and the value of the equity share becomes 500 rupees on maturity, then he will get 500 rupees worth of share. So investor feels attracted towards such instrument because he can either get the face value or he can get the equity share, whichever gives him a higher value. Okay. Then there are certain terms associated with convertible bond. So we will discuss them one by one slowly so that you can solve questions. First, the simplest one is what is conversion ratio. Conversion ratio means the number of shares that each bond can be converted to. That means suppose conversion ratio is 20, it means one bond will be converted into 20 shares. The next is called conversion price. Conversion price is the exercise price at which investor will convert his bond into equity share. Exercise price means suppose the face value of the bond is 1000 rupees and conversion ratio is 50. So conversion price is 20 rupees. So effectively he is paying 20 rupees per share because he would have got 1000 rupees. So either you take 1000 rupees or you take 50 share. So if you go for 50 share, you are using your exercise price of 20 rupees per share for acquiring the bond, acquiring the share. So conversion price is calculated by dividing the par value of the bond by the conversion ratio. By dividing the par value of the bond by conversion ratio. So what you do, write the formula in the book. This formula write down. Conversion price means par value upon conversion ratio. Par value upon conversion ratio. Write down. Par value upon conversion ratio. Example, if the par value is 1000, conversion ratio is say 50. So exercise price is 20. So what you will do, on maturity date you will see what is the price of one share. If the price of a share in the market on that day is more than 20, then conversion is beneficial. If the price of the share in the market on maturity is below 20 rupees, then conversion is not favorable. So please note down the formula for conversion price. It is the exercise price. Now next is conversion parity price. Very similar sounding terms, be careful. Conversion parity price means dividing the current market price of the share by the conversion ratio. And you also write down one more line, also write down in your book. It is also called market conversion price. It is also called market conversion price because in one exam they have asked you find market conversion price, and then the student will say you have not given us market conversion price separately. It is equal to conversion parity price. How do we compute it? It means that take the current market price of the bond and divide by conversion ratio. Take the current market price of the bond and divide by conversion ratio. Current market price, let us assume 265. Example is printed in the book only. And let us suppose the conversion ratio is 20. Current market price of the bond is 265. Conversion ratio is 20. So conversion parity price, that means 265 divided by 20. So effectively you are paying 13.25 per share by buying a bond at 265, which gives you a right to convert into 20 share. It is equivalent to paying 13.25 per share. It is equivalent to paying 13.25 per share. That is called conversion parity price, also called market conversion price. Now next is trade value of the bond. This is suppose Tata Motors. This is suppose Tata Steel. Both of them have issued bond. but this bond is non-convertible debenture. This bond is convertible debenture. This bond is convertible debenture. Suppose this conversion feature was not there. If conversion feature was not there, it was called a simple straight bond. What would be the value of the bond if conversion feature is not there? So we will see what is the price of a similar bond which is same in all aspect but does not have conversion feature. So price of a convertible bond is price of a straight bond when there is no conversion feature, then that is called straight value of the bond. Underline. The straight value of the bond is what the convertible bond will sell for if it would not have been converted into equity share. That is, it is the price of an equivalent non-convertible bond. Okay, let us say you go to a theater and you buy ticket, plus in the ticket you also pay the price of cold drink. You go to another theater where the same movie, only you can purchase the ticket. So this is like straight value of the bond which does not have any attachment, does not have any option, does not have any additional embedded feature. Whereas this bond or this ticket plus the plus you have the cold drink feature also is like a convertible bond. So if I remove that conversion option, what will be the price of the bond? It is called straight value of the bond, and it is also called investment value. Underline, highlight or write down if not written. It is also called investment value. It is also called investment value because in the exam they sometimes use different terminology. In some exam they have used straight value of bond, in some exam they have used investment value. They are same. So how do you compute it? It is simply the present value of coupon and redemption value discounted at YTM on similar non-convertible bond. Write down. It is the present value of, like what we have been doing till now. Till the previous question, what we have done was nothing but the straight value of a bond, present value of all future coupon plus present value of redemption value. The discount rate to be used would be what is the discount rate on a similar non-convertible debenture which does not have the conversion feature. I hope you have written this 2 line extra. The formula for straight value of the bond, just take present value of coupon and redemption value using YTM of a similar non-convertible debenture. Now next is a concept of downside risk. So give me the answer. Usually convertible debentures are issued at option A, option B. Usually convertible debentures are at premium or at discount compared to a non-convertible debenture. If a non-convertible debenture is trading for say 100 rupees, a convertible debenture will be issued for 100 or more than 100 or less than 100. Reply, just write down A or B. Convertible debentures are issued at premium to the NCD or discount to the NCD. Any guesswork? Option A or option B? Reply fast. So usually convertible bonds are issued at a higher price because they are also offering you the conversion feature. Just like the movie ticket plus cold drink will cost you a little more than simply a movie ticket. So convertible debentures are issued at a higher price. Okay. The investor also pays a higher amount because he is hoping that the share price will rise and he will earn more income on maturity when he'll get the shares. But sometimes the market scenario can go bad, situation can go wrong, and the share price of the company can fall. The share price of the company can fall such that it is not profitable to buy share, rather it is beneficial to get the face value of the bond. So therefore, there is a risk involved that the price of the share can fall to such an extent that it is not profitable to purchase the share, rather go for the redemption value in cash. So there is a risk involved that the bond price may fall, and this risk is called downside risk. Okay, so now read the note. If the share price goes much below the conversion price, it is expected by the market forces that conversion option will not be exercised, and the market price of the convertible bond will be equal to straight bond value. Then the value of the convertible bond will simply be equal to its straight bond value, that is PV of coupon plus PV of redemption value, and therefore there will be a loss to the investor, because investor had paid some additional amount to purchase this convertible bond, but now the price of the share has gone down, so he will not exercise conversion option, and there will be a loss to the investor. This loss is called downside risk. How do you compute it? The bond price, the amount you paid for the bond, minus straight value of the bond, that is value of the bond if there was no conversion option, divide by bond price. So example also I have given there. Suppose the price to be paid for a convertible bond is 265, and the straight value of the bond, that is without conversion option, it would have been 235. So what is the downside risk? The value of the bond can fall from 265 to 235. So you may lose 30 rupees. You may lose 30 rupees, that is downside risk in rupees. And if they ask you downside risk in percentage, then in percentage term you may lose, if suppose the market situation goes wrong, goes bad, then you might lose 11.32%. So 11.32% is your downside risk. That means you can lose 11.32% if the market price of the share falls. So that was downside risk. We'll take a question a little later. Just wait. First complete the concept. Now next is the concept of stock value of the bond. Suppose one bond gives you 20 shares and the market price of the share today is 12 rupees. Suppose the market price of the share is 12 rupees. One bond is convertible into 20 share. Price of one share today is 12 rupees. So investor can purchase 12 share today or 20 share today at 12 rupees. How much he will have to pay? He will have to pay 240. But suppose the price of the bond is 265. In order to buy the bond he paid 265. He could have bought 20 shares at 12 rupees at 240. But he did not buy the share. He bought the bond because the bond gives him an option to convert into share on maturity. So stock value of the bond means what is the value of the bond today in terms of the current market price of the share. What is the value of the bond today in terms of current market price of the share? If a bond is convertible into 20 share and the current market price is 12 rupees, it means the stock value of the bond, the stock equivalent value of the bond is 240 rupees. So the formula is in your book, it's written there, current market price into conversion ratio. One more thing, right now I have already written there. It is also called, underline, conversion value of the bond. It is also called conversion value of the bond. Stock value of the bond is also called conversion value of the bond. You have to practice it because there are similar sounding terms: conversion price, conversion parity price, conversion value, market conversion price. Example I have explained. Current market price of a share is 12 rupees, conversion ratio is 20, so the stock value of the bond will be 240. Now comes what is conversion premium. What is the meaning of this word premium? Premium means you are paying something more as compared to other. Something more as compared to others. You can buy a convertible bond for 265. One bond is convertible into 20 share. Each share is of 12 rupees. So the conversion value or stock value of the bond is 240 rupees. You could have bought 20 share for 240, but you bought bonds of 265. So how much premium are you paying? You are paying a premium of 25 rupees in terms of rupees. If you ask what is your percentage of premium compared to conversion value, so it will be 25 by 240. So conversion premium means extent to which market value of convertible security exceeds the conversion value. How much additional premium you are paying as compared to the stock value or conversion value of the bond. It is also called market conversion price. Okay. Just remove. Example. Market price of convertible bond 265. Market price of convertible bond 265. Number of shares per bond is 20. Market price is 12. So if they ask you what is the conversion premium compared to conversion value or stock value, you will say 25 rupees extra we are paying. And if they ask in percentage term, you will say we are paying 10.42% more. Next is floor value. Floor value means minimum value of a convertible bond. How much will be the minimum value of a convertible bond? To what extent the value of a convertible bond can go down? So it will be higher of the two, either the straight bond value or investment value, because if everything goes wrong, at least you will get an amount equal to present value of coupon and present value of redemption, or conversion value, which means number of share into market price, conversion ratio into market price. So the value of a convertible bond is higher of the two. If share price falls by a large extent, at least you will get the straight value of the bond, or if the share price is on a higher side, you will get an amount equal to conversion bond. That is the floor value of a convertible bond, higher of the two. So mathematically we can write maximum of straight bond value or conversion value. Straight bond value means PV of coupon and redemption value. Conversion value means number of share per debenture an investor will get multiplied by market price per share. Now let us see intrinsic value of a bond in the context of this chapter, convertible bond. Since the investor enjoys the option, there is an option embedded in the bond. Investor has a choice either to go for share or he can go for the cash. The optionally convertible debenture also command option value. That means its value will be little more than floor value. Its value will be little more than floor value because the holder also gets an option to convert. So intrinsic value will be equal to that floor value which we have computed, plus because the bond has an option, there is some option value also added. So the intrinsic value is floor value plus option value. And then the next is they can ask you what is the premium over straight bond value. Straight bond value is trading for 235 rupees. Other bonds with similar feature but no conversion option is trading for 235, whereas this bond is trading for 265. So compared to a non-convertible bond or a straight bond, how much premium in percentage you are paying? So suppose this is the bond price, this is straight value of the bond. So the answer would be how much? 30 by 235 into 100. This will be the premium over straight bond value. If they ask premium over conversion value, take conversion value here. If they ask premium over straight bond value, take straight bond value here. Then the next is annual cash flow differential. If I buy a bond, I will get coupon. Instead of bond, had I bought shares, I would have got dividend. Instead of bond, if I have bought share, I will get dividend. ठीक है? When I buy a convertible bond, I pay premium. Suppose I pay premium 25. Suppose I pay a premium on bond 25. Why? Because it gives me a higher coupon. Suppose coupon amount on a bond is, let's say, 100 rupees. Coupon amount the bond will generate is 100 rupees. I buy shares. Shares will give me a dividend of, let us say, 90 rupees. The shares would have given me a dividend of 90 rupees. If I would have bought shares, I would have got a dividend of 90. So how much is the excess cash bond is generating for me? 100 minus 90, 10 rupees cash is generated, surplus by the bond. And how much premium we have paid? 25 rupees. So in order to recover this premium of 25 rupees, if I am getting 10 rupees additional cash flow from the bond, how many years will it take? How many years will it take to recover my premium? It will take 2.5 years. So annual cash flow differential is equal to coupon from the bond minus dividend from underlying share. And then payback period is equal to bond price minus conversion value divided by annual cash flow differential. So in our example, suppose the bond price is, let's say, 265. Conversion value is, let us say, 230 rupees, and the annual cash flow differential, suppose 10. So 25 rupees, that premium which I have paid, I will take 2.5 years to recover that additional premium that I had paid. So it means how many years will it take for annual cash flow differential to give us back the initial conversion premium. Now next concept is conversion premium per share. They are asking you conversion premium per share, which is simple, bond price minus conversion value. Bond price minus conversion value is the conversion premium over conversion value. Divide by conversion ratio. Suppose 265 is bond price, 250 is the conversion value, and conversion ratio is 20. So conversion premium per share we are paying is 25 by 20. Conversion premium per share we are paying is equal to 25 by 20. That is called conversion premium per share you are paying in order to purchase a convertible bond. So by using this calculation, you will understand how much is the risk and reward you are getting. Is it worth paying so much premium? All this will be decided by calculating this kind of numbers. Okay, how much is risk involved? If annual if the payback period is very high, it means it will take a lot of years to recover the initial premium. If conversion premium is also very high, it means you are taking some risk. So with this background, let us solve first some very simple questions of convertible bond. If you can understand this formula, you can easily solve problems of convertible bond. So I would request you to first come to question number 73. You will find question 73 after 2 or 3 pages. This question is from November 2008 exam. Similar questions are there in the study material of the institute also. The data given below relates to a convertible bond. Face value 250, coupon rate 12%, number of shares per bond 20, that is conversion ratio. Market price of the share is 12. Straight value of the bond is already given to you, otherwise you will have to compute in some problem, and the market price of convertible bond is 260. So actually we have used this question as an example in our notes. I had used same numbers in our example as notes. So first question is compute the stock value of the bond. Second, percentage of downside risk. Third is conversion premium, and fourth is conversion parity price of the stock. Okay. So write down stock value of the bond. Stock value of the bond is equal to current share price into conversion ratio. Current share price into conversion ratio. Current share price is how much? Current share price is how much? 12. And conversion ratio is 20. Therefore, 240. Second, write down downside risk. Means the value of the share can go down to the level of straight value of the bond. Even share price falls by a large amount also, at least you will get the present value of coupon and redemption value. So the maximum risk you are taking is to the extent the bond price can go down to straight value of the bond. So please write downside risk equal to bond price minus straight value of bond upon bond price. So how much amount you can lose in terms of present value. So first write down downside risk equal to 265 minus 235 is equal to 30, and downside risk percentage equal to 30 divided by 265, 11.32%. 11.32%. 11.32% is right. Please reply, is it right? Now third answer, write down conversion premium. Conversion premium is equal to, you are paying 265 rupees for a bond. You could have directly bought 20 shares at 12 rupees. So you are paying 25 rupees conversion premium over stock value of the bond. Conversion premium is 25, write down. And also answer in percentage. 25 by 240. 25 by 240. 25 by 240 is 10.42%. 10.42%. 42%. So you are paying 10.42% over the stock value of the bond because you get an option to convert on maturity. Next is conversion parity price. 8 mark question, 2 marks for each right answer. So conversion parity price means what is the price per share you are paying today. So you are paying 265 rupees and you get 20 share for that. So conversion parity price will be current market price of the bond upon conversion ratio. 265 divided by 20, that is equal to rupees 13.25. That is rupees 13.25. That is rupees 13.25. So that was an 8 mark question for in the exam. 8 mark question, bonus mark. Very easy. If you are thorough with the concept, the formula, application, then this will take only 5 minutes and you'll get 8 marks. Now come back to previous pages. Question 70. Okay, now you see question 70 will ask you to solve everything that is there in convertible bond. Okay, this question was artificially designed for you so that in one question you will have practice of all the formulae. Consider the following optionally convertible debenture. Market price is 1090, face value is 1000, coupon rate 10%, maturity 5 years, conversion ratio 4. 4 means 1 debenture into 4 share. Current share price is 260. Dividend per share is 18. YTM on similar non-convertible debenture is 11%. Assume that option value is 10% of floor value that will be required for intrinsic value. After giving this detail, they have asked you only 11 questions, but those 11 questions will help us to go through all the formula. So you have to compute straight value of the bond, conversion value, floor value, intrinsic value, premium over investment value. Straight value of the bond, this is also called investment value. Then premium over conversion price, conversion value, percentage of downside risk, annual cash flow differential, payback period or break even period, conversion premium per share, conversion price and conversion parity price. Did you like this question? Say yes or no. Did you like this? Yes, this is a good question for understanding all the concepts at one place. So tell me, did you like it? Should we solve it or homework? Classwork, in class or in home? Tell me, otherwise I'll give homework quickly. So we will solve in class. First write down straight bond value. Straight bond value is equal to, you have to compute the present value of coupon and redemption value. Coupon will be 10% of 1,100 rupees into PV annuity factor in bracket 11% comma 5 years plus 1000 into PV factor 11% comma 5 years. Solve. Solve it. Try yourself. Give me the answer. Please reply. What is the answer? This is 963.04. Is it right? 963.04. Then write down conversion value. Conversion value is also called stock value. Also called stock value of the bond. Formula is conversion ratio into current share price. Conversion ratio is 4, current share price 260. So the answer is 1040. This is conversion value. Okay. Now write floor value. What is floor value? To what extent the share price can fall? The share price can fall to the higher of the falling to either straight value of the bond if everything goes wrong, or to the extent of the conversion value of the bond if the share price are little higher. So the formula will be maximum of straight bond value comma conversion value, means higher of the two. First answer was straight bond value 963.04, conversion value you have got 1040. So floor value, minimum value of this bond should be 1040. Minimum value should be 1040. Now write down option value. Option value is written in the problem 10% of the floor value. Option value is 10% of the floor value. So 10% of 1040. 10% of 1040. 104. Once you get option value and once you get the floor value, you can calculate the intrinsic value now. You can keep checking the formula which is printed on in the book. Intrinsic value is equal to floor value, minimum value, plus option value, because the holder of the bond also has an option. An option commands some value. There is a value of the option when you get an option. So the answer for this would be 1040 plus 104, 1144. 1144. Next is premium over straight bond value. Premium over straight bond value. So you have already computed straight bond value. So it is also called investment value. This is also called investment value. So whether they say premium over straight bond value or premium over investment value, use the same formula. Bond price is given in the question book, first line 1090. Straight bond value 963.04. Divide by 963.04 equal to, yes, come on, reply fast. Yes, please answer. You are not replying only. You have gone into silent mode. I want to check whether you are writing or not. So 13.18% is right. Very good. Now write premium over conversion value. Conversion value means stock value of the bond. So write down bond price minus conversion value upon conversion value. If they are asking premium over conversion value, so the base will be conversion value. How much premium you are paying? So 1090 for the bond and the conversion value is 1040. So what is the percentage? Yes, come on, reply. What is the answer? 4.81% over and above conversion value. Very good. Keep replying. Percentage of downside risk. Percentage of downside risk means the value of the bond can go down to a minimum level of straight value of the bond. So that is the amount you can lose. So the formula for percentage of downside risk is bond price minus investment value or straight bond value divided by bond price into 100. Bond price 1090 minus 963.04 divided by 1090. Yes, answer please, fast, everybody. What is the answer? 11.64%. Very good, amazing. 11.64%. Now write down annual cash flow differential. Annual cash flow differential means how much is the coupon amount over and above dividend amount. How much additional cash flow you are generating by investing in the bond. So write down coupon income from the bond minus dividend income from underlying share. Minus dividend income from underlying share. If you invest in the bond, you will get 100 rupees coupon. If you purchase 4 shares, which is paying a dividend of 18 rupees per share, you would have got 4 into 18. So therefore, by purchasing the bond, you are getting an additional cash flow of 28 rupees. By purchasing the bond, you are getting an additional cash flow of 28 rupees. So that is called annual cash flow differential. Now write down payback period or break-even period. Payback period or break-even period means how many years will it take to recover your initial premium that you have paid over the stock value of the bond. So for that we will write bond price minus conversion value. Conversion value means stock value upon annual cash flow differential. Upon annual cash flow differential. Come on. So you have paid 1090. You could have paid 1040. So you have paid 50 rupees more. But you are getting 28 rupees additional cash flow also. So you will recover that premium in how many years? 1.79 years. That premium that you have paid will be recovered in 1.79 years. Is there any more question pending? Yes. Next is conversion premium per share. Conversion premium per share. Come on. What is the formula? Conversion premium per share is bond price minus conversion value upon conversion ratio. Upon conversion ratio. 1090 minus 1040 divided by 4. So the student is right, 12.50. 12.50 is your premium you are paying per share. Okay, one more question. Conversion price. Conversion price means exercise price. On maturity date, either you can get 1000 rupees or you can get 4 shares. So if you want 1000 rupees, it is equivalent to paying 250 rupees per share. So you will compare on maturity date whether market price is more than 250 or not. If more than 250, buy the share. If less than 250, ask for cash amount. So 250 is right. Okay, one last answer for this question. Conversion parity price. Solve yourself. Conversion parity price means market value of the bond divided by conversion ratio. Market value of the bond is 1090. Conversion ratio is 4. What is the answer? Divya, 272.50. Very good. Now tell me, did you enjoy this question? Yes or no? If you say yes, then I will give such questions more, which will give you a comprehensive coverage of a particular topic. Yes sir, very good. Now we'll take one May 14 question for 8 marks. Which is that question? Question number 71. Mark, very important. They have repeated it also. They have repeated many times. Very, very important. Highly repeat question. Highly probable question. Question is GHI Limited, a AAA rated company, has issued convertible debenture on the following terms 1 year ago. Then it says face value rupees 1000, coupon rate 8.5%, number of shares per bond, that is conversion ratio is 25, market price 45, market price of convertible bond 1175, time to maturity 3 years, and YTM on similar debenture is 9.5%. So this time they have only asked 5 things: straight value of bond, conversion value, conversion premium, percentage of downside risk, and conversion parity price. So first you tell me, I have given you the answer also. Can you do it as homework? Can you do it as homework? I have given the answer also, and the similar problem I have just now taken. So please reply all of you. Can we do it as homework? Yes. Anybody? Yes. And you can check the answer which is printed below. So it will be easy. And if you have doubt, you will ask me in the next lecture. Final answer must match with our answer. The institute presentation can be different. So question number 71, you tick mark homework. Same question 72 they have asked. Can you see below 72? November 22 exam for 8 marks. Only figures are different. So 72 also homework. 71, 72. Today only you will do in the notebook. I have prepared these notes with lot of efforts. Understand, all questions from beginning of the chapter when they had introduced till recent exam, we have brought it at one place for a particular concept. So all question on convertible bond you will get in our book at one place. You don't have to study now RTP, MTP exam and other study material. Everything at one place. So question number 72 homework you have noted. 73 we have done. 74 also homework because it is also same, which is July 21 exam for 8 marks. Then question 75 also homework. This was also exam question. And question 76 is November 11 6 mark. All question will simply require you to compute the same thing that we have done. Now we'll come to 78 number. Now you see in 78 number, it was asked in RTP November 21, RTP November 12, RTP May 13, and similar question in May 14 for 8 marks. So this also, right, very, very important. They have repeated this question many times in different exam and different RTP, MTP. So first let me read. If you think you can do it, then this question also you can do it as homework, no problem. The following data is related to 8%, 8.5% fully convertible into equity share debenture issued by JAC Limited at rupees 1000. 8.5% is coupon rate. This is face value. Market price 900, conversion ratio 30, straight value of debenture. So one calculation they have done, straight value, market price of equity share on the date of conversion 25, expected dividend per share is rupee 1. Calculate, now you have to compute these items, conversion value, market conversion value. So this time, see, in the exam they have used this term, market conversion value, market conversion price, which means, write down in bracket there, which means conversion parity price. Market conversion price, in bracket write conversion parity price, conversion premium per share, ratio of conversion premium, premium over straight value of debenture, favorable income differential per share, and premium payback period. Easy question. So write down answer one by one. Let us practice one more time for all such numbers. Ready, steady, go. If you have doubt later, then you can email me at email address vinod_ca@yahoo.com, or you can WhatsApp your query on this number 97669 21860. Okay, so you can, when you send the query, write the question number, page number, and photo of the question and answer also. Easy for me to reply. So first answer, please write conversion value of debenture. Little fast. Conversion value of debenture is equal to market price of one equity share into conversion ratio. Market price into conversion ratio. Question in front of you, question number 78. 25 rupees into 30. 25 into 30 is 750. 750 is right. Then B, write down market conversion price. Market conversion price, in bracket conversion parity price, in bracket conversion parity price, which means I will take the market price of the bond, divide by conversion ratio, market price of bond divide by conversion ratio, 900 divided by 30, 900 divided by 30, rupees 30, 900 divided by 30, rupees 30, 30. Next answer, write down conversion premium per share. Conversion premium per share is equal to bond price minus conversion value upon conversion ratio. Bond price minus conversion value upon conversion ratio. So our bond price is 900, conversion value we have got 750 in the first answer, divided by conversion ratio given in question 30. So that is 5. Now write down next answer, ratio of conversion premium. Ratio of conversion premium, that is what is the percentage premium over and above conversion value. So you will write bond price minus conversion value upon conversion value. Bond price is 900, conversion value 750, divided by 750 is 20%. You can get answer by alternative method also, which is printed in the book, and that is also right. Both way you can do it. Next answer, write down premium over straight value of debenture. Premium over straight value of debenture. Please complete the homework today itself, don't delay. Market price of convertible debenture minus straight value of bond upon straight value of the bond. Upon straight value of the bond. 900 is given, 700 is also given. Both are in the problem. Check the answer. Is it 28.6%? Check. Is it 28.6%? Right? Okay. Is it right? Yes. Now, next is favorable income differential per share. Favorable income differential per share. So how much is the additional cash flow per share? You have to find out. Favorable income differential per share. Coupon interest from debenture. Coupon interest from debenture minus, you can write in bracket, conversion ratio into dividend per share. That will give you annual cash flow differential. Divide by conversion ratio, because they have asked per share. If they would not have asked per share, then only the numerator would be the part of answer. So solve it. You will get 8.5% into 1000 minus in bracket 30 into 1 upon 30 is equal to favorable income differential per share. You are getting 1.833. 1.833. Is it right? 1.833. Is it right? And the last is, yes, come on, last part of this answer, premium payback period. Premium payback period is equal to conversion premium per share. Both are in per share, otherwise you can take total also. So conversion premium per share we have already calculated. Divide by favorable income differential per share. If you don't write per share, then you can take total amount also. Answer will be same. So tell me, conversion premium per share in third answer was how much? 5 rupees. And favorable income differential per share in this answer is 1.833. Is the answer 2.73 years? Is the answer 2.73 years? Is the answer 2.73 years? Yes. Now if you look at question number 84 after 2 or 3 pages, exactly same question in November 18 exam homework. Just you will have to practice the same thing again and again, so that if this kind of questions are asked for 8 marks, you can easily score. Okay, so one more similar question they have asked is question 84, exactly same. Just have a look at it. You will be able to do. Today you will be able to do all homework. That will give you a practice of all formulae. Okay, one more question for today. Question number 77 from November 2009 exam for only 4 marks. Do you want 4 marks or we should just leave it? Tell me, 4 marks you want or ignore? If you say yes, then I will take. Yes sir, we want 4 marks. So easy question and it will take 2-3 minutes only. Don't worry. ASF Limited has issued convertible debenture with coupon rate of 12%. So underline coupon rate 12%. Each debenture has an option to convert. Each debenture has an option to convert into 20 equity share at any time until the date of maturity. This is a different question. This will solve in the notebook. You have an option to convert one debenture into 20 share at any time till maturity. Debentures will be redeemed at rupees 100 on maturity of 5 years. So in case if you don't convert, at the end of 5th year, you will get 100 rupees. An investor requires a return of 8% per annum on a 5-year security. So that is my discount rate. As an investor, when will you exercise the conversion option? As an investor, this is a new question, underline full thing. As an investor, when will you exercise conversion for given that the market price of equity share is 4 rupees, 5 rupees or 6 rupees? So when will you exercise the option to convert into equity share? You will exercise the option to convert into equity share if the amount realized by converting into equity share is more than the value of the bond at that point of time. So we'll have to see if market price is 4, what is the value of equity? If market price is 5, what is the value of equity? If market price is 6, what is the value of equity? And that we are going to compare with the price of the bond, and we will decide under which situation conversion is favorable. So you are given discounting factor also, use it. So first thing what I'll do, first I will compute the price of the bond today. Then I will compute the value of the bond for 3 different conversion for 3 different prices, and we will see at which price the share price is more than the present value of the bond. So that is how the decision making will be done, which is more beneficial to me. So step 1, write down. Step 1, calculation of present value of debenture. In bracket write assuming no conversion option. Assuming no conversion option. Draw the format and solve. Draw the format and solve. You will solve, I will check. Anybody answer? Anybody answer of this question? Yes, please reply. Anybody answer of this question? Take the factor from the booklet only. Yes, the answer is somewhere close to 116. One student have got 115.90. Very good. You are also right. So this is the value of the bond today, and there are 3 possible share prices given. It can be 4, it can be 5 or it can be 6, and one debenture is convertible into 20 equity shares. So therefore I will see what will be the value of the bond under the 3 scenarios. So write down step number 2, value of equity shares. Value of equity shares, 3 columns: market price, numbers, total value. Market price, numbers and total value. So market price is 4, number is 20, total value is 80. Total value is 80. Market price is 5, Number 20, total value 100. Market price, if it is 6 and you get 20 share, the value is 120. What is the price of the bond? 115.9. And the price of this share can be 80, 100 and 120. So now you will reply, I will check whether you are understanding under which of these three scenarios you are going to convert the bond. When share price is 4 or 5 or 6, which will give you higher value than the bond value? Come on, reply. You will convert when the share price is 4 rupees, 5 rupees or 6 rupees. What is your answer? 4, 5 or 6? Come on, reply. So the answer is 6 rupees. You are right. Because when the market price is 6 rupees, the value of equity share will be more than the value of the debenture. So write the conclusion, unless market price is rupees 6, unless the market price is rupees 6, conversion option is not to be exercised. Conversion option is not to be exercised. Now institute repeated this question after 9 years in the exam. In May 18, same question was repeated with different numbers. 79 number also note down homework. You will find it is almost copy paste version of question number 77. Is it right? So will you be able to solve all the homework today? Please promise yes or no. Promise. Yes, we will solve. Okay. So thank you very much. Thank you.